I take it you just alluded to it there. It's possible for a person to have multiple policies, yeah, as long as you're within that lifetime limit of about 25 multiple of your annual income. Is that correct? Yeah.
Correct. Yes, exactly.
Yeah. Yes. So I'll just the next question was what are the downsides or the fees and everything else involved that people should be aware of?
Yeah, some of the downsides is it's not free money. You have to capitalize the policy. You have to have the discipline to actually put money into the policy, and be disciplined to keep paying the premiums over time. You have to agree to that. And then another problem with that or downside is you can never in the beginning you can never borrow more than you actually put in. So, for example, if you are if you have $50,000 and you want to go and buy a property that's $500,000, in that sense, you can't use the policy because you need a traditional loan for that. And that's not always a bad thing. We want to incorporate, if we can incorporate other lenders, that's fine. But we want to be able to at least start building this policy, for the future. So, for example, what you could do is it's not like either or. It's not either, I use my bank on yourself money only, or I use third-party lending only. You could use a combination of both. You could structure the policy, get the third-party financing, use some of your profits to pay back into the policy, and then borrow from that. There's a lot of things you could do. My biggest advice or recommendation is, you have all your, think about all, your cash flow, your job. If you have real estate investments, if you own a business, try to take this policy and put it in the middle of everything you're doing, not necessarily to replace what you're doing, but just to put it in the middle and pretty much for you to, because everybody, a lot of people nowadays are having a hard time saving money. They make $1 here and they transfer it to this hand and they spend it. So it comes in this way and it comes out this and it goes out this way. So you need to figure out a way so that way your money comes in, it can go to an account, and then you can borrow from that account. So this way you're able to capture and grip your money in between you earning it and you spending it. That I think is pretty much the most crucial thing about this, the most important part about this.
Wow, that's great. That's really good. It's very interesting concept. Understanding that you can actually do that. So that's really great for you to share. So for people who are looking to make a start, how can they find you, and what are the processes involved to get started in Bank on Yourself?
Yeah, absolutely. So listeners can go to finassetprotection.com. It's FIN assetprotection.com, and there you could schedule a free appointment. And as a special Alex for the listeners, if they say the name from your show, I will send them a free copy of the Bank on Yourself Revolution book by Pamela Yellen. I'll send it to them for free via Kindle. The book is like $15 on Amazon, but if you register for a free consultation and then say that you came from Alex's show, I will send you the book for free via Kindle. It's finassetprotection.com.
Is that finassetprotection.com? Yeah.
Correct. Yes.
Let's see if we can put it up on the screen. Okay. Is that correct? finassetprotection.com?
Correct. Yes.
Okay. So people can go and find you on there and get in contact with you based on what extra information that they require. But it is definitely a great concept, especially for the fact that they can use their cash values from the insurance policies. And it's just a great way as well for people to, practice the discipline of actually saving on a regular basis, and then over an extended period, get the cash values as well. Is there anything else that our listeners should be aware of that you need to share with them?
Yeah, you can't utilize a strategy with all whole life insurance. There's a couple things you have to know. Number one, it has to be from a mutual insurance company, not a stock-owned insurance company. So mutual insurance companies give their dividends and profits back to the shareholders, to the policy owners, whereas stock-owned insurance companies give their dividends and profits back to the shareholders. You want to be with a mutual insurance company. So that way you can actually get dividends from the insurance company and build up your cash value. Number two, you want to make sure that the policy is properly structured. It's not just 100% whole life insurance only. You want to make sure that there's something called a paid up additions rider. That's the part of the policy that turbocharges the cash value. You want to make sure that's added to the policy. It won't work if it's 100% base or 100% life insurance. And then the third thing is you want to make sure that this is something called non-direct recognition loan. This means that if you have cash value in the policy and then you borrow from the insurance company will not minimize the interest and dividends they pay you based on your outstanding loan. So if you, for the example mentioned earlier, if you have $100,000 in cash value, you borrow $50,000 from the insurance company, you're using that money. With non-direct recognition, the company will not recognize that you have that loan. So they'll keep paying you dividends and interest on that money, which is what you want. You want to be able to borrow money and still have it grow at the same time, as opposed to direct recognition, which means that when you borrow, they will reduce the interest and the dividends you're getting because you have an outstanding loan. So to recap, it's mutual insurance company, properly structured with the paid up additions rider and a non-direct recognition loan.
Yeah. Wow. Is there an indication roughly? I know you mentioned that each individual situation is different, and also depending on the cash values that you're getting at. Is there a rough indication of the kind of premiums for a particular cash value or death benefits that people may go for on average, perhaps? Or
it's really hard to answer that, but I'll give you some examples. Like, for example, I worked with a real estate investor. He sold one of his properties for $400,000 in cash. He then took that cash, bought a single premium whole life insurance policy. And then as soon as he did that, as soon as he bought the policy, he had cash value available of $375,000 in cash value. And then he had a death benefit right away of $580,000 in death benefit. And then both the cash value and the death benefit grow every single year without any further contributions, without any further money being put into the policy. They still grow. So that's kind of an example of a single premium in that sense. And then other policies, like for example, my policy that I did when I first started off, I started putting in $300 per month. So in the first year, I was putting in like $3,600 or $300 times 12. And about half of that was available for cash use. So I had like $1,800 in cash use, and I would borrow from that, and I would pay down some credit cards and use that money, and then kind of pay back the loan. And then when the policy renewed a year later, I had the option to pay $3,600 again, and then I had the option to also add another $3,000 towards the cash value part of the whole life policy. So I wrote the insurance company a check for $6,600 for it to be paid the whole year, and then plus for the cash value to build up even stronger and faster. And now I'm good. I paid up the policy for the whole year. I'm good until next year. Next year, who knows how my financial situation will be next year? But I've just satisfied all the payments for this year. Next year, and if next year, I'm in a better financial situation, which I'm hoping I am, I'll get another policy and do that all over again. So that's kind of gauge the listeners' minds in terms of like what happens when you fund the policy.
You fund the policy. So I take it from what you're saying, if, for example, you're paying monthly, it is possible to accelerate your payments. So if you want to pay up, let's say you get a win for some cash and you want to just pay it up for the year instead of continuing. Can you? I guess that is possible within the policy. Is that right?
Yeah, absolutely. Yeah, it's flexible in terms of the paid up additions rider. It's flexible. You could add more. You could pay up the whole year. A lot of things you could do, and you could base it around your financial situation, because we don't want to enroll someone in a policy that they can't afford. This is meant to help them financially, not to become a bill. It's meant to create financial freedom for the future. So we want to do it right. We want to structure it right, and we want the flexibility. We need the flexibility. Everybody needs the flexibility, especially if you own a business. You work on commission only. You need a way to be flexible with the payments.
So just to get one point cleared as well. So when you're going for a particular cash value, let's say the 100,000, and you're making the contributions, are we saying that your money keeps growing towards that 100,000, or that 100,000 can grow into something bigger depending on the returns that it's getting as well? What's the split between those two?
Yeah. So if I'm understanding your question correctly, is it pretty much the more you put into the policy, the more it will grow? Is that correct?
Yeah, like the more, let's say I'm going for a cash value of 100,000,
Yeah.
and the premium is, let's say I'm paying $500 a month. Yeah, that cash value of 100,000, does that increase with the investments that are coming? Like, for example, if the company issues dividends or anything like that, does that increase the cash value, or the cash value is fixed?
Oh, gotcha. Okay, yeah. So the cash value, the cash value keeps growing. It always keeps growing, and it grows two ways. It grows so the insurance company guarantees you interest every year on your cash, and then plus dividends. Dividends are not guaranteed, but we only work with insurance companies who have been paying dividends for over 160 years.
Yeah.
So there's two ways it grows. And then when you're adding more into the cash value, that's also increasing the cash value. So in theory, there's like three different ways that you can increase your cash value. One, by adding more into it. And then the second, from the compound interest you earn on it. And then from the third, from the dividends you add. So then by that rationale, it would make sense for you to put as much money as you possibly can into a whole life insurance policy because of the guaranteed growth. Eventually, the money will multiply over time. With tax advantages, of course, and guaranteed liquidity too. So even if you put the money in, it's not like you've just lost that money or you've just spent it. You're moving money from the bank to your whole life insurance policy.
Yeah. Is it possible to lose all your money?
The only way that's possible is if you stop making payments and completely ignore your policy and you let it lapse, you let it get canceled. That's how you could lose all your money. But even in that situation, you can get a return on your premium back. So like, for example, if you've been funding the policy for 10 years and you have $100,000 in cash value and then you want to stop making payments, it wouldn't really make, in theory, like you can get that money back. That's your money. You can get a return on your premium back towards you, and then you can cancel the policy. There might be some tax stipulations, or there might be some penalties, maybe if you did that, if you just let it cancel. But that's one way. Or another way is if you borrow the money and then you lost the money, you invested it, you lost it, and then you never paid back the policy loan, that could also, you could lose your money then.
You can lose your money. And in terms of regulation, I take it all these companies and insurance companies are properly regulated by the relevant authorities if people have complaints or issues or anything?
Oh, yeah, definitely. Insurance companies are highly regulated. They're the most regulated industry. And definitely the companies we work with have been around for over 160 years. They have all A+ ratings. They're in good standing. They take compliance very seriously. They only work with, compliant agents and compliant advisors. It's a very, big deal. They're even more highly regulated than banks,
Wow. That's great. Now, Sarry, thank you very much for all the information. I think we've got a great deal of detail there, including how people can actually find yourself and get more information on that. So, I think we'll put up the site there and how people can contact you. And take things from there depending on their individual situation. So it's been a pleasure speaking to you, and that was great content on understanding how the bank on yourself concept works. And looking forward to catching up with you and a lot of our listeners getting in touch and getting the benefit of this concept from yourself. So thank you very much for today, and I'm sure we'll catch up very soon.
Thanks, Alex. Thanks for having me on. I appreciate it.
Cheers. Thanks, Sarry.
Bye.